Hey, Bowtie Nation. Joseph Hogue here with Let's Talk Money. Welcome to another Beer Money Sunday. Actually had a gym day today, so it's coffee for me, but whatever you're drinking out there in the nation, you go ahead and have at it. See a lot of a lot of our Bowtie Nation regulars here in the chat. Thank you for being here Sundays. I love doing these live streams. Gets a little bit more face to face with you out there in the community, answer some questions and talk about a topic each week. And this week we got a great topic for you, very timely, kind of a stock market news a video for you, really all around the House passage of that foreign stocks delisting notice, and we're going to talk about that. Talk about whether you should be investing in Chinese stocks, if there's any danger there, and maybe even some opportunities. I know a lot of people are out there saying, hey, why do I need Chinese stocks? That whole geopolitical risk, the government risk with that, but you can't ignore some of these companies. Alibaba, 25% annualized return over the last 5 years, right? 25% a year over the last 5 years, and I think it's still undervalued. This is the Amazon of China, and got a lot of good fundamentals behind it. Nio up 11-fold this year, so you definitely cannot ignore some of these Chinese plays. And I'm going to kind of explain what was behind that. That House bill is probably going to be passed into law, what that means, and what you should do with your Chinese stocks. See everybody coming in on the chat from Belgium, Columbus, Ohio. I saw Albany, New York, and Pennsylvania earlier. Welcome. Thank you for being here again. It just, it amazes me every weekend. I love connecting with all you out there in the, in the 2 p.m. messes with my workout time. Yeah, I gotta, when it falls on Sundays, I gotta do it either really early or really late, and I can't enjoy my Sunday beer. But we're gonna get to it. So we're gonna get to it here. Just a reminder, the Webull 4-stock promotion, it has been extended through December 14th, I guess. Just talked to Webull this week, and they said they were going to extend it. A lot of people asking about it. If you know Webull, the platform, stock trading platform, I've been using it for a little under a year now. Love it for that trading kind of idea. They were have a stock simulator app on the on the platform that's really fun to use. You basically just kind of simulate your trades. They give you $1 million paper money. You follow your trades before you invest your own money. So I love using that feature. And in the past, they've done like 2 free stocks when you open an account and when you fund it. Now they're doing 4 free stocks. So you get your first 2 just for opening an account. Don't even have to deposit any money. But then when you make that first $100 deposit, they give you 2 more stocks. So, tends to be $8, $10 stocks. Not a ton, but you deposit $100, you get $40 in stock. That's a pretty damn good return. Supports this channel, so I appreciate it, and it is a good platform to use. So look for that link there in the chat. I've pinned it on the chat, or I'll pin it in the first comment below as well. So we're going to get to it here. We're going to do a little bit of recap real quick. Last week's videos, next week's videos coming up like we usually do. Do that China stocks theme, and then we'll get to your questions and answers after that. Again, thank you everybody for being here. I see a lot of good questions already coming up in the chat. Nio, JD.com, Alibaba, a lot of those stocks that could have very good futures. Alibaba, like I said, Alibaba is the Amazon of China, and I feel like we're still, where we were at with Amazon 10 years ago with Alibaba, as far as the valuations, as far as the market reach and the reach for that company. The Singles Day, which is kind of their big Prime Day or whatever for Alibaba, that keeps setting records every single year as far as internet traffic and all that. So yeah, I just don't think you can ignore a lot of these great companies that could be the future of really investing. So last week it had a couple really fun videos for me. Friday, the life lessons video, if you don't remember, out on the community page there on the channel. Great way to just kind of connect, and kind of a social media site there on YouTube. But on the community tab a few weeks ago, I asked what was your favorite life lessons or your biggest life lesson, and got huge responses. Got something like 95, 96 responses to those. And so what I did Friday was really cool. I went on the Cameo app, which you can you can talk to a bunch of celebrities to read messages off for you, basically. And I got 7 celebrities, and these were really cool. These were people like Tom Arnold, Chuck Norris was there, Gilbert Gottfried, Randy Couture, to read these life lessons back on a video, as well as offer a lot of their own life lessons as well. It was really interesting, some of the life lessons these celebrities offered. So go back, check out that video. That was on Friday. That was yesterday or Friday, because yeah, and especially the life lesson offered by Tom Arnold, comedian Tom Arnold, fellow Iowa native, a really amazing story about, how he set a goal to make his father laugh when he was younger. Single parent, raised those 3 kids, Tom being one of them, and it was really an amazing story. Check that out and check out that video. Next week, just real quick before we get to the theme this week, next week we've got a big week for videos. 3 videos tomorrow. Monday, we're going to be covering the SPACs. Big topic. I know everybody's been asking me to do a video on those special purpose acquisition companies. So I finally took the time, dug in a little bit deeper, and really looked at these, and was kind of surprised what I found. There's some very nice, legitimate companies there. Some of them, the Bill Ackman's SPAC is a good one. Highlighted couple others, highlighted 3 SPACs that I'm watching, but also the risks there, because there are some major risks in these SPAC companies. Okay, they don't call them blank check companies for nothing. Okay, so definitely watch that video tomorrow if you've ever thought about investing in these SPACs, these special purpose acquisition companies, because there's definitely some risks and some things you need to know before you invest. And then Wednesday and Friday, we're going to continue with our 2021 investing theme, that series that we're going. A really neat step-by-step strategy to start investing and to turn it into a cash flow and an income there on Wednesday, sharing that. And then Friday, one of my favorite stocks, one of my favorite videos to do each year, a dividend stocks for 2021. So I put together a list of the 5 dividend stocks I'm putting in my own portfolio for 2021. So be watching for that on Friday. So I want to get to the topic today because it is timely. Everybody is talking about this last week. It is going to passage. So basically what happened is this bill was passed in the House. It had already passed in the Senate. This is the U.S. Senate. It's called the Holding Foreign Companies Accountable Act, right? And basically what it says is that it threatens to delist any foreign companies. And when I say foreign, that's pronounced Chinese, right? Because that's really what the target of this bill was. Threatens to delist any of those Chinese companies if they fail to comply with the U.S. Public Accounting Oversight Board's audits, okay? And that's for 3 consecutive years. So now what this is the Public Accounting Oversight Board, right? The PCAOB, okay? It's a 5-member board here in the United States appointed by the SEC. And it oversees all the audits of public companies, right? So any company that with listed shares on the markets has to get a quarterly and an annual audit, right? Just to make sure, an accounting firm has to come in, they check their books, they check what they're reporting to make sure that it's legit and it meets accounting standards, right? Just for that transparency. So they go in and they don't necessarily, this PCAOB that doesn't inspect the companies, it inspects the accounting firms, right? It makes sure that the accounting firms are doing these audits within those standards and that the outcome is transparent. Okay, it was created in 2002 as part of that whole Sarbanes-Oxley after the accounting scandals like Enron and WorldCom. It registers public accounting firms and then sets those as accounting standards, and then it inspects them to make sure that they're following those when they do these audits of public companies. So it's just a very important tool for transparency, for accountability at any company that's going to be listed on the U.S. markets, right? Kind of, it obviously doesn't minimize the risk to zero that there's going to be accounting fraud or fraud at companies, but it's just a much higher level, a much higher standard of accounting and auditing, right, and transparency. Well, what happens is the Chinese authorities have long resisted this, right? They don't want the PCAOB coming in, or foreign regulators coming in, inspecting their accounting firms and their companies, right? It's they put it behind the trade secrets idea. They put it behind a national sovereignty idea. Who knows why, really? So securities regulators have really been fighting that idea of they don't want foreign companies coming in, inspecting their accounting firms, inspecting their companies. And, I mean, part of it is they just don't want loss of trade secrets, right? Which, I don't want to get political about it or anything, but come on, China has benefited from theft of property secrets, for decades, right? They've been able to say that companies wanting to do business in China have to have they can't have a majority stake in the company. They have to set up partnerships, and then obviously the companies have been able to benefit from that intellectual property that's brought into the country, and brought in from that. But it's a sovereign nation. They can set their own rules and everything, and yeah, they don't want they don't want their trade secrets shared, just like we didn't want ours. Okay, so that's really what we're looking at, right? Is this Holding Foreign Companies Accountable Act was passed in the House. It's going to be signed by the president. He's already said he would sign it and supports it. So basically, what we're talking about here is after 3 years, okay, because these if you don't pass that. If the accounting firm doesn't pass that that PCAOB inspection for 3 consecutive years, then you can delist the stocks, right? So it's got to be 3 years. So one, it's going to be 3 years before anything happens on this anyway. But there's also a lot of reasons why Chinese stocks might not necessarily be in trouble. Okay, a couple of reasons. First is that this only affects those Chinese accounting firms, right? So basically, if those Chinese accounting firms don't let the PCAOB or other foreign regulators come in and inspect those accounting firms, then after 3 years, then any stock that uses those accounting firms to audit their financial statements, then they can be delisted. But especially a lot of the large Chinese stocks, we're talking Nio, I think maybe even Alibaba, they're using U.S. accounting firms to audit their financials anyway, already. Okay, so this has no effect on them. Okay, so that's one. So if you're investing in a Chinese stock that uses a U.S. accounting firm to audit its financials, audit those financial statements and reports, there's nothing to worry about there. Now, another part of that's probably largely symbolic at this point. It gives the firms 3 years for compliance, and there's probably likely going to be additional years after that, if nothing else. We've already seen some give on this by the Chinese government on the issue, and it's likely going to allow a little bit more oversight into its accounting firms, right? It's probably going to, rather than lose that funding source from the U.S. markets, it's going to allow some kind of foreign, auditing or foreign oversight into these accounting firms, right? Now, what I wouldn't be betting on is some of the a little bit more closely held funds or closely held companies in China, right? Now, I don't want to get into a discussion, or I don't want to see any chats about how the Chinese government is communist and they control all the companies. No, come on. Let's be honest here. Let's not give in to all the propaganda and shit we hear. China is no more communist right now than maybe Brazil or even a lot of countries in Europe, right? Okay, maybe the government has more influence on companies, but it's not controlling these companies. But for the most part, it's not stealing their data and all that kind of stuff. That's just kind of propaganda and bullshit, really. But what I would be worried about is those state, a little bit more state-controlled companies where the state does have a high ownership and control of that company. And here I'm talking about things like I'm talking about things like the insurance companies, the financials, so the banks. I'm talking about the PetroChina, so the energy companies. Obviously, the government is going to hold a majority stake and be state-controlled in those companies. So, I wouldn't necessarily be betting on those, and I never really have. Okay, I have liked China Life Insurance for a period there because it was excellent valuation, and we ended up doing very well on shares of that. But for the longer term, I would be hesitant to invest alongside the government in those kinds of companies. But when you're talking about other companies, Alibaba, Baidu, NetEase, JD.com, the Nio, I don't think you have to worry about any kind of state control, state influence, things like that on these companies. If nothing else, that domestic that domestic influence, that domestic power, being a Chinese company is going to help these companies, right? You know, all countries are protective of their own industries, whether it's explicit or maybe even implicit. And China's no different, right? It helps, through subsidies, through special rates, lending, that kind of thing. It's going to help its own companies, just like every company does. Okay, so that's going to benefit Alibaba, Baidu. That's going to benefit all of those local domestic companies. So long story short, you don't this Holding Foreign Companies Accountable Act, the Chinese stocks delisting, that whole thing, really a non-issue at this point, right? Where it does help you is that it has created a little bit of a buying opportunity. These stocks didn't come down a lot on this news because the market's looking at it and saying, so what? Nothing's really changing right now, and probably not likely to change. But they did come down a little bit, and like I said earlier, a lot of these stocks were already trading at pretty good discounts. What we're looking at here, if you look at a lot of the emerging market funds, a lot of money managers, they're already underweight Asia and underweight China because of the trade war and the geopolitical risks over the last 2 years, right? So not necessarily just this act or this law coming up, but just over those last 2 years, they've really underweighted the country and the stocks from domestic to that country. So what we've seen is, especially over this last year during the coronavirus, is the Chinese market and its stocks have really outperformed U.S. indexes, not just for last year, but for the last 2 years now, really. The economy is arguably in better shape going into 2021. Now, no, I don't fully trust China's reporting on their own coronavirus cases, but even feet on the street reporting of their economy, traffic demand, that kind of thing, or traffic. A lot of the real time data that we get from money managers, from portfolio managers, the economy is set better off. Okay, going into 2021. The stocks are undervalued because all these portfolio managers, they're underweight in the area, so there's not that demand to it. So you get a lot of these great long-term holds that are undervalued right now and have a good chance to go forward in 2021. I think there's a good chance you see that momentum start building. Like I said, the Chinese indexes and the Chinese stocks have outperformed over this last year. And I think you see that momentum keep building into next year and maybe even beyond. Maybe as some of the rhetoric gets toned down a little bit, but just really as portfolio managers start to, come back into Chinese stocks and that kind of thing. Some individual shares that I've been looking at, obviously, I'm a big fan of Alibaba. It's trading right now at about 11 times earnings, which is closer, versus about 20 times last year. So if you just take it on that basis, on a historical PE basis, I mean, it's almost half the value, right? It could potentially double from here just on that 20 times PE multiple, right? But trading for 11 times right now and against a 93 times multiple for Amazon, right? Now, I mean, I'll admit Amazon just, continues to confound value investors, right? Amazon never trades below 50 or 60 times earnings. On the face of it, horribly, tragically or expensive, but the stock keeps on going up. So, I wouldn't necessarily say 93 times multiple is super expensive for Amazon because Bezos just surprises us all forever. But when you compare it with Alibaba, 11 times earnings versus 93 times earnings for Amazon, the model is almost identical. In fact, I would say Alibaba basically they just looked at Amazon and they just do what Amazon is doing, right? They just copy that for that market. And it's going to be the largest market in the world. So, I can't see how Alibaba at 11 times earnings is not a great deal. Clearly undervalued company doing 30% sales growth a year and a profit margin of 22%. So definitely one to look at. For its part, Baidu, a little bit different model there, business model, trading at 14 times earnings, down 42% from the April 2019 peak. They've still got the revenue growth, good fundamentals. It's not quite as good as Baba. So, if I was trying to decide between the two, they're not necessarily one for one kind of a decision there, but I like Alibaba a little bit better. Again, other ones you can look at, that JD.com, the Nio has had a huge year here. Maybe getting a little expensive. I'm hesitant to jump into the electric vehicle stocks right now, just because of the pandemonium that has been in the share prices lately. But a lot of great stocks there. Again, I would avoid probably some of the more closely state-controlled companies like PetroChina, China Life, the energy, the banking, and the financials there, because those are going to be a little bit closer state-controlled. And as we get closer to this 3-year window where stocks are going to be delisted if they don't meet these PCAOB regulations, these standards, then you could see some weakness in those state-controlled companies like that will probably just delist in the U.S. and then list over in Hong Kong.